Hello everyone, my name is John Cunnison. I'm the Chief Investment Officer at Baker Boyer National Bank. And I'm pleased to welcome all of you to the first of what will be brief quarterly updates on the markets and the economy. And the purpose of the video is really for our portfolio management team to give you a glimpse into what we're thinking about the major drivers of changes in the financial markets. If you have any questions about anything we talk about here or things that we didn't mention that you want to hear more about, please reach out to a member of your Baker Boyer team. So let's jump right in. So the first topic that we want to address today is inflation. And I know we're not alone in talking about inflation. The second thing, I would say the second most important thing, would be slowing growth. And those two things are related. So I'll be spending some time today talking about the relationship between inflation and the potential slowing growth that we're likely to see in the economy, both in the US and around the world. So in some ways, it's kind of amazing right now that we're talking about having to fight high levels of inflation, and especially since we just spent the last decade really fighting two levels of inflation that were too low. The Federal Reserve was trying to get levels of inflation up. Now we're fighting the opposite problem. And coming out of a pandemic that carried so many risks of, that came out of having to shut an economy down, a global economy around the world, coming out of that experience with levels of inflation that are high, growth that is high, unemployment that it is low, all of those things are, in some ways, reasons to be thankful, but they aren't without risks, and we'll talk about that today. So the inflation that we're seeing today is the result of an economy that's growing very, very quickly and creating a lot of jobs. And there is such a thing as an economy that's almost too strong or growing too fast. So right now, the economy is creating more job openings than we have workers looking for jobs. So that creates a situation where firms are going to have to compete with each other for those available workers. They're going to have to increase wages, increase the compensation of those workers. And we are seeing wages going up. We're seeing labor markets very, very tight, levels of unemployment very, very low. Now, one of the challenges that comes with this, this all sounds very good, right? Everybody who wants a job can find one. We're seeing wages going up. All those things sound really good. Now, the challenge comes with the idea that as the salary expenditures for these firms goes up and goes up, fairly sharply, you're finding that they're going to have to take some portion of that expense and they're going to have to pass it on in the form of increased prices on their products to consumers. Consumers like their own employees. So if you were to get a 5% increase in your salary in a given year, but prices go up 8%, well, your purchasing power hasn't increased. So that's one of the challenges that we're facing. But beyond just the challenges of increasing, costs of living, we're really, one of the challenges that high and persistent levels of inflation present is that the Federal Reserve is going to have to act to cool inflation, to bring inflation back down. And in doing that, they're going to have to cool demand. So the inflation that we're seeing is caused by lots of demand. And that is, normal and natural. That's caused by people who've come out of the pandemic, both with the desire and the dollars to spend. And they've been doing that, during a time when supply chains are still adjusting. And that's a recipe for inflation. So the Federal Reserve, they predicted this. They predicted that we would see some inflation coming out of the pandemic for all those reasons, that we emerge, pent-up demand, lots of dollars in our pockets, but they thought it would be temporary. Now, it turns out that it hasn't been temporary, and we're seeing inflation moving into goods and services that are more sticky, things like rents, and this has concerned the Federal Reserve. So the Federal Reserve is determined, and they've really changed their tune on this. No longer do they think inflation will be temporary. In fact, they think that it's very concerning to them, and they've expressed this to financial markets, that they're going to be very aggressive in increasing interest rates to cool demand and bring inflation back down to more normal levels. Now, they've increased interest rates by 0.25%, which doesn't sound like a lot, but just their signaling to financial markets has already increased interest rates quite a bit. Now, most observers think that we're likely to see short-term interest rates at close to 3% by the end of this year. And again, right now, those short-term rates are at 0.25% set by the Federal Reserve. They're likely to be at 3% by the end of the year. That's a big move. And in the middle or end of next year, we're likely to be closer to 4%. So big moves up in interest rates. And now what does that mean? Well, it means that the cost of borrowing and spending, both for businesses and individuals, is going to go up. It also means that what they call the propensity to spend, right? The desire to spend your money may go down if by not spending it, you can put it in a savings account and get a little higher level of interest rate or interest on that money. So spending or demand is likely to come down. Economic growth is likely to slow. And this is where inflation and slowing growth come together. So the challenge of the Federal Reserve is to contain inflation, bring it down to more normal levels that allow for more business planning, and to do that without cooling growth too much and slowing the economy too much. What they especially want to try to avoid is pushing the economy into a recession, which is defined as 2 quarters of negative growth. Now, we think, and I think most observers would agree, that the likelihood of recession in this year or next is less than 50%. It's not our base case. But with what the Federal Reserve has said they're going to do with interest rates and increase them as quickly as they've planned, it definitely increases the risk of a potential recession. Now, that doesn't mean it needs to be a deep recession. These recessions can be rather shallow. And I think most observers would suggest if we do see a recession, that's the type of recession we'll see, simply because economic fundamentals right now are fairly strong. Now, if the headlines right now that you are seeing and experiencing are unnerving to you, you are by no means alone. And while it's really important for all of us, in fact, it's an important part of my job, is to sort of look at these risks, assess these risks, and mitigate them. It's also important to understand that during these periods of rapid change and disruption, they often are periods of innovation and they're periods of opportunity. But 2 that I think are important to point out. One is the development of an effective vaccine for the coronavirus, with the speed at which it was produced, is really just a glimpse into the innovation that's going on in the life sciences today. And the potential just innovations and growth that come out of that are just astounding. The other thing that I think is important to point out is the changes in the labor market that has come from this vast experiment that we just did, and I would argue largely successful, in remote working. So if we have an economy with a very tight labor market where firms are struggling to find workers, if they have the ability to hire a worker, a Los Angeles firm has the ability to hire a worker in New York that they really need, that creates incredible dynamism in our economy to have that kind of flexibility in the labor market. So those are just 2 things that have come out of this period of turmoil and change, and I think we're likely to see more. With that, I want to thank all of you for joining us today. Again, if you have any questions at all about anything you heard here or anything that you didn't hear, we're always happy to talk about it. So thank you for joining us, and be well.